Hey there, I'm Casey, and this video is about high-frequency trading on Wall Street. And it was inspired by Michael Lewis's new book, Flash Boys. And in that book, Michael Lewis totally blasts these high-frequency traders as scalawags and swindlers. In fact, in his interview about the book on 60 Minutes, he said that the entire United States stock market is rigged. Okay, now that is a pretty strong statement. So this video will explain what high-frequency trading is and what it's all about, what Michael Lewis is saying in his book and why he thinks it's a big problem, and also what the high-frequency traders are saying and why they think what they do is perfectly fine. So let's jump right into it here. Let's start by taking a look at a chart. Okay, so this chart is just a simple YX chart here. On the Y-axis, I have the stock price, so the price of the stock represented in dollars, this little dollar sign here. The X-axis is time, represented by this little clock here showing the time. And the time here is 1 day. So here you've got, $0 on the X-axis, 0 down here, and, a lot more money up here. I don't know how much, I don't know, call it 200 bucks or something like that. I'm not putting any units here because the units really don't matter. I'm just illustrating points. And this 1 day, this would be sort of this opening of the market, say at 9:30 in the morning. And so this would be like noon. And then this is the closing of the market at like 4 o'clock. All right, so let's put up the chart of the stock performance over the course of a single day of a single hypothetical company. Okay, so what this graph is basically showing that, so the company starts off here at, 9:30 in the morning when the stock market opens here. So 9:30 here, call it, I don't know, 100 bucks right here. Okay, so it opens, stock market opens, then time goes on for about the next, first 45 minutes or so in the morning. The stock doesn't increase or decrease at all. Then after about 45 minutes or so, it starts to increase. So it increases, it keeps going up, 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 up in price for about another, I don't know, 45 minutes or so. Then it hits a peak, and then all of a sudden the price starts to decline. So the price goes down, 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 down for the next, hour or so, whatever, until it hits a bottom here. This is probably about noon or close to noon. Then it hits a bottom, it starts going back up again. The price increases, increases, increases for the next, half an hour or so. Then it kind of goes up and down for a while, maybe 20 minutes. And then for the next hour or so, the price goes up, 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 and then it levels off for the next hour. And then the last hour of the day, the price goes up. So overall, the price opened here at 100 bucks and ended up higher here, at some point higher. All right, so how do you make money in the stock market? Well, the way you make money in the stock market is the old adage goes, buy low and sell high. And that's basically what it all comes down to, actually. The only problem is that the devil's in the details, right? So how do you know when to buy and when to sell? That's the trick, right? So if you could buy low and sell high, you're going to make money. But the trick is, how do you know when to get in and when to get out? So that's the whole thing, is predicting the future, right? If you could predict the future, then you could make money easily in the stock market, right? So let's say, for example, you had a crystal ball and you knew at the beginning of the day at 9:30, you knew what this chart was. You could see this chart, you could see the future, you could see what was going to happen to the stock during the day. Well, then you'd know, okay, I'm going to wait, I'm going to buy here, right, the lowest point in the day, and I'm going to sell here at the highest point in the day. Buy low, sell high, lock in that profit. And you could do things along the way, like you could buy here and sell here, buy here, sell there, right? So the whole thing is about predicting the future. So what is high frequency trading? So high frequency trading is a form of electronic trading or computer trading. Okay, well, what is electronic trading? And that is basically a way that traders have developed to try to predict the future. Because if they can predict whether a stock's going to go up or down, that's how they can make money. So what computer trading is. So in order to try to predict the future, what traders do is they do a bunch of research and they look at a whole bunch of factors that try to help them predict whether a stock is going to go up or down. So they might look at factors like the performance of the individual stock, certainly whether that's going up or down, but they might compare that to the performance of the overall stock market, like the Dow or the S&P or both, or sub-stock markets like the Russell 2000 or whatever various indexes are. They might also look at interest rates and the unemployment rate and all sorts of stuff. So that's a lot to remember, right? It's hard to process all that information. So they, of course, computerized it. It's ripe for a computer application. So what they have is they have the computer on their desk, and that computer is getting streams of information in split seconds, fractions of a second from the market with all sorts of data. Okay, data about the market, interest rates, companies, share prices, all sorts of stuff as to what's happening. So then what the computer programmer does is they write a program, and that program is what they call an algorithm, or for short, an algo. It's just a fancy term for a computer program. And that computer program processes the information and determines when to buy or sell a share of stock. So for example, that computer program might look at all these factors that the trader wants it to look at, like the index stock price, interest rates, unemployment rate, how the Dow's doing, all that kind of stuff. And then if certain things happen, if interest rates go up by this much and the Dow goes up by this much, and the companies that are in the same industry competitive set as this company go up or whatever, then buy the shares. Okay, so tell the computer program to buy the shares. And the computer doesn't just tell me to buy the shares and I pick up the phone and call my broker. No, that's the old-fashioned way. What happens is the computer itself actually buys the share. So it processes the algorithm and then it actually buys the share. And then I also have another algorithm that tells the computer when to sell the share. So during a trading day, I'm the trader, there's really nothing for me to do. I don't push any buttons or anything. The computer itself is doing all the buying and selling based upon the algorithms that I have written to tell the computer when to buy and when to sell, because it processes all this data to help it predict the future as to whether the stock is going to go up and down. So that is electronic trading or computer trading. So high frequency trading is a form of that. So high frequency trading is basically exactly what the name suggests. It's trading at frequencies that are high. In other words, you're doing a lot of trades. So for a high frequency trader, what's happening is the computer is programmed with algorithms that are constantly getting this data and getting the data from the market in thousands, fractions of a second, analyzing that data and then buying or selling shares on a very rapid basis, okay, over and over and over and over again. Now, as you can imagine, if it's buying and selling, sometimes it'll be in positions just in and out for positions in whatever, a second or a couple seconds or maybe even less than a second, very quickly. Now, you're not going to make a lot of money on an individual trade if you're only in it for a couple seconds, right? Because there's not going to be enough profit during that period of time. If the stock's not going to move that much to make that much profit. So how do they make the profit? Well, it's sort of like that Superman movie. Was it Superman 3 or whatever, when the bad guy trims a penny off of every single transaction, so nobody misses a penny, that nobody notices it on their balance sheet statements. But over billions and billions of transactions, the bad guy becomes super rich, which was parodied actually on the movie Office Space, which was a hilarious movie. So it's kind of similar to that each trade, they're making only a very narrow margin of profit, but they do trades over and over and over and over again. Thousands of trades, tens of thousands of trades a day, over and over and over again. So each trade only makes a little bit of money. In the aggregate, you make it up in volume. With a huge volume of trades, you can have a pretty good return. So as you might imagine, speed is critical to these people. Now, speed as we know, computers themselves are fast, so computers can process the information fast, but the game has been not the speed of your computer, but rather the speed of executing the trade with the exchange and back. Okay, that's where the lag occurred. So in the last, 5 to 10 years, there has been a speed race with all these hedge funds building out their own fiber optic high-speed networks to try to get greater and greater speed to be able to process their transactions fast. So when they want to sell, when their computer sells, they can go over a high-speed network to the exchange, execute the trade, and get it back, fully executed, so they can do it very quickly. Because if you're trading over and over and over again in fractions of a second, you can't be delayed by 10 or 20 minutes to execute a trade. You need to execute that trade fast. So that has been the sort of speed race for trying to be able to process trades quickly among these firms, these high frequency traders. So that is what high frequency trading is. So they do thousands and tens of thousands of trades a day or more. And they build their profits up, over time, over all these different trades. So you might be thinking to yourself, well, what's wrong with that? And so far, nothing. Even Michael Lewis would say he doesn't have a problem with electronic trading or computer trading. He doesn't have a problem with algos, and he doesn't have a problem with high frequency trading in and of itself. Okay, so what's the problem? Michael Lewis is saying there's a problem. What he's saying is that these high-frequency traders are using this technology and doing bad things with it. Okay, that's what he's saying. And when he's sort of saying that these Wall Street insiders are doing bad things, there is a long history of Wall Street insiders doing bad things. I mean, some of this stuff is shocking. I mean, one fantastically interesting period is the 1920s, when it was the Roaring '20s, and this was the lead up to the stock market crash in 1929, which then led to the Great Depression for decades later. But if you look in the 1920s, it is crazy, all the stock manipulation schemes that were going on Wall Street, and they were legal because there was no law against them. So these people were doing all this stock manipulation stuff, and the Main Streeters got this reputation that these people on Wall Street are a bunch of sharks, and it's a snake pit, and you can't trust them, and they're swindlers and all that, and for good reason, because it turned out it was true. So there were all sorts of different types of scams that now are well known and now are illegal, but they weren't illegal then because there was no law against them. So for example, there's the big famous one is the pump and dump scheme, which you've seen iterations of over and over and over again. They would form what they called trading groups or trading pools. So a broker who's going to do a pump and dump scam, say, I would have a trading pool of a whole bunch of people that were in on it with me, and basically what we do is we pump and dump together. So what pump and dump means is you pump the stock, meaning that you call people and you tell them how great it is. You pump it up, and I would have my network of people in my trading pool, and I would tell them to all pump the same stock. So we're all calling our customers and saying, oh, what a great stock it is, got a hot tip, you got to get in, whatever. So what happens when you pump the stock is the stock price goes up because there's more buyers and sellers. The law of supply and demand is if there's more buyers than sellers, the price goes up because the commodity or whatever it is more scarce, so it becomes more valuable. If there's more sellers, the price goes down because more people are selling, so the price goes down. So on a pump and dump scam, what would happen is, let's say, the broker would come in at, 9:30 in the morning here, and the broker would start off by buying the stock for himself and for his, his trading pool, the people who are in on it. So let's just say this is $100 when it opens. So the broker would buy the stock for himself at $100 right here. Then he gets his trading pool and he gets on the phone and starts pumping the stock. Hey, everybody, hot tip, buy ABC company, buy ABC company, buy the stock. So everybody believes him and they start buying the stock, right? And so the stock goes up, but it's going up artificially because there's nothing that the company is doing, ABC company is doing, that would cause the stock to go up. It's not like they're making any more money or anything. The only reason the stock is going up is it's artificially going up because people are pumping it and saying buy, buy, buy. So you got all these people who are buying, and let's say they push the stock up to, say, 105. Okay, so once it reaches 105, the broker says, well, I just made 5% today, and it's only, 10 o'clock in the morning. So I'm going to sell now. I'm going to sell out my shares at 105 because I'm happy with my profit. So what do? I sell my shares, and not only my shares, but my trading pool, everybody who's in on it with me. I instruct them, everybody sell. That's the dump part, okay? So everybody dumps their shares and they sell their shares. So what does that do? That creates downward pressure. The price now goes down and the stock plummets. And all these people who got in, they all get terrified as the price is dropping. So then everybody starts selling and the price plummets. So what happens at the end of the day is I made my money, right? And my little syndicate here of scammers, we made our money, the 5% we locked in, and a lot of people ended up losing money. And it's basically Wall Street versus Main Street, right? Main Street ends up getting screwed because they are not in on the scam that I'm doing. And it was crazy what these scammers were doing. They also would include journalists, respectable journalists would be part of these pools. They pay them kickbacks. So they would call up a journalist and say, hey, on Friday, print in your column, in your weekly financial column, print that the ABC stock company is going to do great, right? So then on Friday, I get my pool and we all, start pumping the stock. So imagine if you're in Main Street sitting there and you're getting calls by your brokers saying, oh, hot tip, ABC company. And then you open up the newspaper and you see a great article on ABC company. And then you look at the price and, the price is starting to go up. You think, wow, this is great. I'm going to get in on it. So, these scams worked. It was amazing how they were manipulating the price of companies. Other things they were doing was the classic bear raid, which is basically very similar to the pump and dump, except instead of profiting when the stock goes up, they would profit when the stock goes down. And basically, they would short a share of the company, which I'm not going to explain what shorting is here, but a short is when you can profit when the stock of a company goes down. So what would happen is they would short a share of the company, and then they would start spreading all these rumors about the company, in their pools, in their, trading pools. So everybody would go, oh, that company, that's going to go down. That's a terrible thing. You better get out of that stock. So everybody would start bailing out of the stock, and the stock would artificially go down for, no good reason. And then, again, the pool would profit. There was also, the churning strategies where you just buy a bunch of the shares back and forth. So for example, in our trading pool, I would sell back and forth the shares with people in my trading pool. I'd sell to them, they'd sell to me, back and forth and back and forth. And what that does is it creates the impression that there's a lot of sales going on and at higher and higher prices, and it helps to, boost the price of a stock. But it's all artificial. That increase is all, price manipulation, of the stock by us doing trades that aren't real. So it wasn't only stockbrokers either. I mean, other people started getting in on it too, like company managers. There was a famous story where there was a steel company and the managers, so they had all their stock. They owned a bunch of stock in the company. Their stock is it's $60 a share, and they sold all their stock. Then they announced that they were going to shut down plants, their steel manufacturing plants. Well, that's certainly bad news. So that caused the stock to tank, right? So the stock goes down to $40. Then they went back in and bought all their shares back up at $40, okay? And then they announced, you know what, things are fine. We're going to keep the plants open. Okay, so then, okay, everything's fine. The stock goes back up to 60, and they just made $20, for no good reason. They manipulated the price of the stock. And, one of my favorite stories of the time, this was actually in the late 1800s, but it was Cornelius Vanderbilt, the Commodore, the guy himself, not his kids or grandkids. So he owned this railroad company, and he won a license from the city. There was the New York City Council. They granted him a license to start a trolley train up and down Broadway in Manhattan. Broadway is like a main thoroughfare in the center of Manhattan that runs up and down it. And when that news was announced, his stock, tripled. It went from $25 to $75 or something. So the city council then, the members of the city council, they start thinking, they're starting to get bright ideas here. They're like, wow, you know what? We can have an effect on the price of the stock. So they start engaging in this little cabal plot here. And what their plot is that they'll short the stock, meaning that they will profit if the stock drops. Then after they short the stock, they will revoke the license. Okay, the city council is going to revoke the license, and then they're going to cash out when the stock drops. Okay, I mean, it's stunning that the city council is engaged in this kind of stuff. Well, the story actually ends in a wonderful ending. It was so Vanderbilt, the Commodore, gets wind of their little cabal, and so what does he do? He actually secretly goes around and buys up all the shares of the company. So he owns all the shares now. Okay, so when the city council members go to close out their positions, they called covering a short. And again, I'm not going to go into short selling, but in order to execute the trade, what you have to do at the end of the trade is you actually have to obtain the shares. You have to buy the shares in the market, and you have to deliver them to the guy you contracted with. And it's not a payment, it's actually the shares. So they got caught because the Commodore basically cornered the market in his own stock by buying all the shares. So when they went to try to buy the shares so they could deliver him the contract, Vanderbilt wouldn't sell them to him. They couldn't buy the shares, so they were in trouble on their short contract, and supposedly he ended up charging them $175 to get out of the trade. So they lost a ton of money and he profited. So poetic justice there. So there's all this crazy stuff going on Wall Street during the 20s. It was just shocking. And then the stock market crash happened in 1929, which, caused the Depression. And all of Main Street was, they just had this impression that, Wall Street caused this whole thing, this Great Depression with all those sharks on Wall Street. It's basically a snake pit, of, these people doing all these sorts of, manipulations. So they put pressure on Congress. Congress looked into it and certainly, uncovered all these, stock scams. And that's basically when they started regulating the securities market. So that was, they passed the Securities Act of 1933 and then the Exchange Act of 1934, which are basically, that's the legislation that governs the securities law regulation right now to this day. They also created the Securities and Exchange Commission, the SEC, in 1934. And there's a great story on this as well. So FDR was president then. Franklin Delano Roosevelt was president of the country. So he appoints the first head of the newly created SEC, Securities and Exchange Commission. And who does he appoint? He appoints Joe Kennedy. And that's Kennedy is the Kennedy name that we all know and love. This is JFK, right? So, John F. Kennedy was the president of the country back in the 60s. And, he's the guy, ask not what your country can do for you, but ask what you can do for your country. That guy who was assassinated. And it's funny because the Kennedy name is, revered, Camelot and, all of that. And, but the truth is that JFK's father, Joe Kennedy, he was actually a swindler. He was one of these Wall Street swindlers in the 20s. He made a fortune getting down on all these swindles, right? So FDR's advisors, actually, when he wanted to appoint Joe Kennedy as the head of the SEC, they came to him and said, FDR, dude, you can't appoint Joe Kennedy to the head of the SEC. He was one of the swindlers. You can't make him the top cop. And Roosevelt's response was, it takes a thief to catch a thief. I love that story. So Joe Kennedy was actually the first chairman of the SEC, and actually he did a lot to clean it up. So that was the dawn of the SEC and securities regulation. So they enacted a bunch of rules to kind of try to stop these shenanigans. So back to today, this is what Michael Lewis is arguing. He's basically saying that Wall Street is back to creating its shenanigans, and they are engaging through high-frequency trading. They're engaging in bad conduct. And the main bad conduct that he's talking about is something that's called front running. That's really the main category. There's some other categories, but the front running is really the one that's kind of getting all the headlines. And he's not the only one to criticize high frequency traders for this. This has kind of been around for a while. A number of people have criticized it for a period of time now. So what is front running? Front running is not any sort of thing that's unique to high frequency trading or unique to computer trading. Front running is, again, another one of these kind of schemes that Wall Street is engaged in over the years. So the traditional form of front running is that, so if I'm a broker, right, I get a call from my client saying he wants to buy 100,000 shares of ABC company, and assume that that's like some big order. Okay, so what I'm supposed to do now as the broker, I'm supposed to say, okay, client, 100,000 shares, hang up with him. Then I put that order into the marketplace. We want to buy 100,000 shares. So then all the people who own the stock, start to sell their shares to me. Well, that order of 100,000 shares is a big order, so it's big enough to move the market, meaning that order is going to change the price of this stock. And again, it's back to the law of supply and demand. If there's more buyers, the price is going to go up. So with such a large order of 100,000 shares, that's like having a whole bunch of buyers. So that ends up increasing the price. So basically what would happen is, here's the point in time where I would go out with the $100,000 order, the 100,000 share order. So what happens is the price gradually goes up. As I'm buying these shares, 100,000 shares, the price continues to go up. And so maybe it'll be up to 105 by the time I'm done filling that order. So over that, aggregate price, he would have paid 100,000 for some of the shares, 105,000 for other of the shares. So the aggregate price he's going to pay is probably somewhere in the middle, 102.5, call it. So what front running is, now remember, we talked about, the way to make money in the stock market is if you can predict the future. Okay, so if I'm an unscrupulous broker, my client calls me up and says he wants to buy 100,000 shares, I start thinking to myself, I now have information that's going to move the market. Right? I know that once I put this order into the market for 100,000 shares, I know that the price is going to go up. Okay, so if I know the price is going to go up, I can cash in on it. How do I cash in on it? What I do is, before I announce to the market that there's this order for 100,000 shares, what do? I buy myself from my own account. I don't tell my client, I don't tell anybody. I just buy a bunch of shares from my own account at 100 right here. Okay, so now I've got my own shares that I bought at 100. Then, after I've bought my own shares for myself, then I go to the market and say, hey, we want to buy 100,000 shares. So then what happens? The price starts going up, 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 up. So by the end, it's going to be at 105, right? And that's where I cash out. After my client's order is filled, the price is now at 105. I'll start cashing out on the shares that I paid 100 for. I just locked in that 5%. Okay, and the reason it's called front running is because it is the broker, me, running in front of my client's order to get to my own order, right? So the client orders 100,000 shares. Instead of just processing that order, I run in front of the client, front run the client, and I buy from my own account so I can make money because I know it's going to increase. That practice is now illegal. Wall Street can no longer engage in that practice, okay? But that's what Michael Lewis is saying is, and not just Michael Lewis, but others as well, but that's what Michael Lewis is saying in the book, is high frequency traders are engaged in front running. Okay, so how are they doing that? So what they're doing is, this is the allegation is, so remember we talked about the algorithms that these guys, are programming their computers on. So, the algorithms, will look at, let's look at, the interest rate, and let's look at the Dow and all of that, all this data. Well, they also can look at a whole bunch of other things. So there's also some algorithms that look at orders that are being placed in the market on all the exchanges. Okay, so that's what the algorithm is doing. They program their computers to constantly monitor every, thousandths of a second, over and over and over again, monitor all the orders that are coming into all the exchanges. And if they see a big order, like let's say they spot an order of, the client saying 100,000 shares of ABC company. Okay, what their computers will do, they'll spot that order first. And because their computers are faster than anybody else's, their computer will execute a trade to buy 100 shares right away, faster than anybody else, before that the order can start to be filled, before people start to sell to the guy who wants to buy 100,000 shares. The high frequency traders will process an order and start buying these shares up for themselves, just like the broker did. Remember that the broker would buy the 100 for himself before his client? Well, with the high frequency traders, their fast computers are able to buy at 100. Then once other people see that order and start to process the order of 100,000, the stock price goes up. Then the high frequency traders will sell out here at 105, and they'll lock in that profit. Now you might say to yourself, well, who's being hurt? It doesn't sound great that the high frequency traders are able to just line their pocket, but are they really being hurt? And I think the answer is the person that's being hurt is the guy who's putting in the order for 100,000. And the reason that he's being hurt is because when the high frequency traders buy this share for 100 for themselves, they are actually adding to the volume of buyers. And since there's more buyers, and if they buy a lot of the shares, those high frequency traders are actually increasing the price, causing the price to increase even more than just the 100,000. In other words, let's say the order, a way you think about it is instead of the order being 100,000, let's say the order was 200,000, right? Because the high frequency traders buy 100,000 and this guy buys 100,000. So it ends up increasing the price. If it weren't, just as an example, hypothetical, if it weren't for the high frequency traders, say the guy who had the $100,000 order, he would start buying at 100 and then end up buying, so he's buying shares and the price goes up, he's buying more shares, price goes up, buying more, and then he buys his final shares at 105. So he buys some at 100, some along the way. Let's say his aggregate price is somewhere in the middle, so let's say it's 102.5 he paid. But if high frequency traders are front running him and buying before he can fill his order, then that's going to result in him paying more money. So instead of the aggregate at where he pays at 102.5, his aggregate might be something more like 103 or 104 because the high frequency traders, when they jumped in and bought, they were increasing the price. So nobody's really disputing that there is a premium that is being paid for the people who end up buying. So those are the people who end up getting hurt from this strategy. So that's the allegation of them engaging in this practice of front running. Now the question is, okay, well, is that illegal? isn't it illegal? Now, Michael Lewis says he doesn't know. Okay, so I don't know whether that's illegal or not. Okay, and that in and of itself is pretty telling. I mean, he wrote this book all about blasting these high frequency traders, basically for this practice. That's the big one. Yet he's not even able to determine whether it's illegal or not. So that means it is not clear. It is not at all clear whether this is legal or not legal. Now, Michael Lewis points to the fact that the authorities are currently investigating this stuff. So the SEC has an investigation. There's prosecutors who are investigating. The FBI announced that they've been looking into this for a while. So people are looking into this, trying to figure out whether it's legal or not legal. So we'll have to see, what they come back with on, the results of their investigation. But that does kind of tell you something, that if, these people can't even say that it's illegal now. It kind of suggests that it's probably not illegal, right? So, but you might be thinking to yourself, wait a minute, how can that not be illegal? If it's illegal for the brokers to do it on the old school way, when they were jumping in front of their clients, how can it not be illegal for these high frequency traders to do it when, they're engaged in basically in the same practice? So what the high frequency traders would say as to why it's not illegal is they would say, no, there's a huge difference between the old practice that it's illegal and our practice. And they would say, the old practice involved trading on inside information, right? So what that is if I'm the broker, my client calls me up and says, I want to buy 100,000 shares. I am the only guy with that information. The market doesn't have that information. I haven't put it out into the market yet. I am in possession of this insider information. So if I am trading on that insider information that nobody else in the market knows, that is what the problem is. That is what is against the law, trading on that inside information. But they would say, the high frequency traders would say, I think, and by the way, I haven't read Michael Lewis's book, so I'm not sure if he goes into this, or I haven't heard what the high frequency traders are saying. But my guess is that this is what they would say. What the high frequency traders would say is, the reason that what they have said, by the way, that they think they're absolutely clear that they think they're absolutely not violating the law in all of this stuff, including, this, alleged front running stuff. They're saying absolutely, we have done nothing illegal. We are in full compliance with the law. They're very clear on that. So why do they think they're complying with the law? And I think this is what they would say. I think they would say, the reason what they're doing is okay is because their information they are getting from the marketplace. Okay, that order for 100,000 shares, it was already put into the marketplace. It was already submitted. It's public information. So all they're doing is they're just trading on faster because their machines are faster, but they're not trading on any inside information. It's all public information. So an analogy would be sort of like, so let's say the Wall Street Journal publishes, an article on its webpage at noon. Okay, so that article, let's say it's about, some company, and it's clear that's going to make the stock go up. Like some company has great earnings this quarter, exceeded expectations, or they just won some FDA approval to make a drug or something. Clearly going to make the stock go up. They publish that article on their website at noon. So let's say one guy happens to be sitting at his computer at noon, and he sees the article come right on the Wall Street Journal website, and he trades immediately because he knows the stock's going to go up. There's nothing illegal about that. Now, there's maybe another guy who's out to lunch at noon, right? And he doesn't get back to the office until 1 o'clock. And by 1 o'clock, it's too late. The stock has already gone up. So too bad for that guy, right? He lost out. The guy who was sitting at his computer, he traded perfectly legal. There's nothing wrong with that. He just happened to get the information earlier than the guy who was out to lunch. Again, I think that's what the high frequency traders would say. They would say, look, the order for 100,000 shares went into the marketplace. It was public information, just like the Wall Street Journal publishing it on noon. Our computers are faster, so we're able to see it first and trade on it, just like the guy saw it at noon. And if you guys don't have fast computers, sorry, you're out to lunch. That's not my fault. There's nothing illegal about it. I think that's what they would say. And so, what do I think? Does that have any merit? I think it does. I mean, we'll have to see what happens, because there's also a lot of murkiness in this business going on about people paying to get information earlier and to get trade flows. And that really complicates the picture, because if it turns out that these high frequency traders are getting information and are trading on information that other people don't have, that can actually be a problem. But if it turns out that they're only trading on information that's widely available in the market, they're just trading faster, I don't know. It seems like it's going to be hard to, take those people and put them in leg irons. So we will have to see. So that is basically what the allegation is all about on front running. Now, that's not the only allegation. And also, I should say that, I think what the high frequency traders would say is, this isn't the only stuff that they're engaged in, these kind of scalping, practices, that they also do a lot of legitimate high frequency trading of, just looking at the, the basics, like, comparing interest rates and the Dow and all that, totally legitimate without doing any, these sorts of things. Now, Michael Lewis says, that's one open question, which is, what percent of all these high frequency trades are actually engaged in this kind of scalping activity, and what percent are legitimate? And who knows, maybe it could turn out that 99% are scalping, or maybe it could turn out that only 1% are scalping and the rest are legitimate. So we'll have to see how that plays out. But that's not the front running is not the only allegation. There's another allegation, which is exchange market arbitrage. Now, I'm not going to go into this in great deal. I'll just give you a very quick flyover so you just get a little bit of a flavor of it. So arbitrage, what arbitrage means, it has a very specific meaning on Wall Street. And what that meaning is it means you are locking in a risk-free profit in a trade. Okay, you might think, how can that be possible to have a risk-free profit? Usually if you take more risk, that's how you make profit. You have to take risk. You can't have a risk-free profit, otherwise, none of us would be working. We'd all be engaged in risk-free profits. But there is the classic example is when there's an imbalance in two different markets. So say, for example, that the prices of oranges in Florida is $100, but the price of oranges in California is $110. Okay, so those two markets are now out of equilibrium. So what the arbitrager would do is would buy the oranges in Florida for $100 and sell the oranges in California for $110, and then they'd have a profit of $10. Now, you might be thinking, well, wait a minute, they've got to transport the oranges, and by the time they get them to California, the price might change and they might rot on the way, and all sorts of risks like that. Those are risks. And you're right, they are. But just assume that they aren't. A way to think about it, because I'm just flying over this one, a way to think about it is if I enter into two contracts simultaneously. So I'm sitting in New York, say, I would enter into a contract to buy the oranges in Florida, and simultaneously with that contract, I enter into a second contract with someone in California to buy them from me, to sell them. So two contracts, simultaneous, buy, sell at the exact same time at a profit. I lock in that profit without taking any risk because I entered into those contracts at the same time. So that's the theory of arbitrage. So what is the allegation against the high frequency traders in terms of the exchange market arbitrage? So the allegation is this. Let's say that there's a company that trades, the same company trades on two different exchanges. Okay, so let's just take like Facebook. Let's say Facebook trades on two different exchanges, exchange number 1 and exchange number 2, okay? Now, when you look at the price of Facebook on both of these exchanges, it's the exact same. Let's say $100. I don't know what Facebook's trading at, but let's just pretend $100, okay? So it's $100 on exchange 1 and it's $100 on exchange 2. Those markets are in equilibrium, okay? Then, let's say somebody puts an order in on exchange 1 to buy 100,000 shares of Facebook. Okay, again, I don't know if that's a lot or a little, but let's assume that that's a big order. It's going to move the market. So what happens? When that order goes into exchange 1, the Facebook price on exchange 1 goes up. And there is a lag in time before exchange number 2 realizes what's going on exchange 1 and then increases their price to match it, so that price is in order. So for a moment in time, there is an imbalance in those markets. So what do the high frequency traders do? They have written algos, these algorithm programs that scan the markets, scan the different exchanges, all the stocks on different exchanges constantly in thousands of a second, right? Over and over and over again, thousands of a second, looking for these price imbalances. And when they detect the price imbalance, so here in a flash, a fraction of a second, they would see the price imbalance. They would see that the price increased on exchange 1. And so what would their computers do? In a fraction of a second, they would immediately buy Facebook shares on exchange number 2, where it's cheaper, hasn't gone up yet, and simultaneously turn around and sell those same Facebook shares on exchange number 1, where the price is higher, thereby taking advantage of that difference and locking in the price risk-free. Okay, that's the allegation on arbitrage. Now, arbitrage is not illegal. In fact, many accountants or economists would tell you that it's a very important function to keeping the markets in equilibrium in a free market society. And the reason is because, pricing is so essential in markets. So if markets start to get out of balance, then arbitrageurs play a very important role because they go in right away and start exploiting the balance and bring the price back into balance. So on my orange example, is let's say in Florida they're selling at 100, but in California 110, arbitrageurs would jump all over that. So there'd be a bunch of people who would buy oranges in Florida and a bunch of people who'd be selling oranges in California. So in a very short period of time, the price of oranges in Florida would rise, right? Because a lot of people are buying, again, supply and demand, more buyers. So that price rises. And what would happen in California? There's a lot of sellers, so that price would fall. So as the California price is falling and the Florida price is rising, they will then match in equilibrium, and pretty soon the price will meet in the middle. It'll be like $105. Once it becomes $105, it's $105 in Florida and it's $105 in California. That market is back in equilibrium, and there is no opportunity for arbitrage, and the world is a beautiful place again. So once those markets get out of balance, arbitrageurs jump in and it fixes the market. So arbitrage in and of itself is not illegal, and I'm not sure what the charge is on these arbitrages, if there's any allegation that it's illegal. I haven't heard that, and maybe that's why it's not getting as much attention, but it is just another example of what they're saying in the book, that is showing how these high frequency traders are actually exploiting the system with their new technology. So that's basically it. That is basically the explanation of what high frequency trading is all about, and what Michael Lewis is saying in his book as to why it's a problem, and what the high frequency traders are saying why they don't think it's a problem. They think it's perfectly legal. So I guess let me leave you with just one thought here, and I guess that thought is it's sort of the elephant in the room. Regardless of whether this is legal or not. I mean, if it's illegal, then these people are going to jail, and there's justice in the world. But if it's not illegal, I mean, clearly there's a sense that there's something wrong here, that this isn't right, that people shouldn't be able to, lock in profits this way. I mean, they're basically gaming the market. But from a larger sense in our society, take a look at this. I mean, our best and brightest people, graduating from the top universities, what are they doing with their lives? Instead of helping society, I mean, society has real problems, poverty, wealth inequality, healthcare, a lot of problems here. And instead of our best and our brightest working to solve these problems, they're going to Wall Street and working for hedge funds and figuring out how to game the system. And you know what? They're getting paid tens of millions of dollars a year. I mean, some of these hedge funds are billionaires. These hedge funds have created out of high frequency trading. They're billionaires now. And so, these, our best and our brightest are using their talents in trying to figure out how to game the system and get rich for themselves. Now, the inclination might be to blame these individuals. Hey, you guys are bad people. But I'm not sure that's really fair. And it's hard to even think about this, but it almost suggests that it's not really their fault for doing this. It's really the fault of our own society, our own markets. Our own society has incentive structures that don't seem right? Because we are incentivizing people that you can make tens of millions of dollars for figuring out how to game the system, but you can't make any money trying to help solve poverty and wealth inequality and healthcare and taking care of elderly and all that kind of stuff, or solving the Social Security problem. There's no money in that. So it kind of seems like, it's up to us to figure out a way to properly incentivize people and properly pay people, right, for doing things that we would want them to do, as opposed to paying them a whole bunch of money for doing things that doesn't really contribute very much to our society. So maybe if we all get together and start thinking some high frequency thoughts, maybe we could solve this problem. Anyway, that's the video. Thanks for watching. I'll see you next time.